2020 is not particularly significant, other than it's the one that we're staring down right now. But these bullet points that I'm going to be conveying are applicable from forever. So anyway, with the next slide, please. This is a brief outline of what we're going to be discussing here today. This is part of a 3-hour workshop that I conduct twice a year through SCORE Hawaii down at the SBA. And not all these topics are we going to have time to address today, especially the ones dealing with individual income tax matters. I'm primarily interested in small business owners and getting them ready to close up their year and get ready to file their income taxes. So a brief introduction, a brief background in taxation. In 1909, Congress authorized or passed the 16th Amendment, allowing the federal government to put across an income tax. It became law in 1913, and things were never the same either in the United States or in the world after that time. But it's the law of the land now. We're going to be discussing taxable events, which is primarily personal versus business income taxes, and how those are basically taxed on individual tax returns. Again, I'm not going to be getting into that too much. I'm more interested in minimizing your business taxable income, and then coincidentally, the individual tax considerations on your 1040 are that much less important as well. But we're going to be discussing tax planning. The problem is the income funnel, which is personal W-2 income versus business income. And the goal here is to get your taxes down to 7 to 10%, if not down to 0. And the plan is to basically pick the best entity through which to report your the ebbs and flows of money in and out of your company bank account, whether it be a sole proprietorship, partnerships, LLCs, corporations, of which there are 2, C Corps and S Corps. I'll be discussing the legal and tax considerations of the various entities. Again, I normally have 3 hours to convey this message, and even that's a stretch. So a lot of this will be like skipping a stone across the water. We're not going to have a lot of time to light on any specific topics. I'm trying to hit what I feel are the most important ones that I have been my experience over the last 40 years of working with small businesses and filing their tax returns. We're going to be using tax planning techniques with regard to taxable events and matching income and expense over various time periods, time frames, fiscal years, calendar years, that type of thing. So with that, I want to ask the very first question I normally ask. The first time I asked this question was about 5 years ago up at Schofield Barracks, part of the Boots to Business program. We had a room of 40 GIs who were ending their college, their military careers and wanting to start their own businesses. And I asked them how many of them felt they had a moral, ethical, or patriotic responsibility to pay income taxes to the federal government or to the governor. And it's not surprising enough, all 40 of them raised their hands. By the time I got done with my presentation, I asked them the question again, and none of them raised their hands. That's how quickly they realized that not all entities are created equal or equally, and they have far more control over the timing and the magnitude of taxing events than they ever thought possible. So with that, in terms of whether you have a moral, ethical, or patriotic reason for paying taxes, I would like to go to the next slide. This is a quote. I don't know who Judge Learned Hand is. I hear that he's a federal court judge in New England. Most of these PowerPoints are ones that I inherited from a fellow SCORE volunteer whom I took over the educational workshops from. But the quote basically goes like this: anyone may arrange his or her affairs so that his or her taxes shall be as low as possible. He or she is not bound to choose that pattern which best pays the Treasury. There is not even a patriotic duty to increase one's taxes. Over and over again, the courts have said that there is nothing sinister in so arranging affairs as to keep taxes as low as possible. Everyone does it, rich and poor alike, and all do it right. I don't know about that, but for nobody owes any public duty to pay more than the law demands. The operative words there are the law demands. What is the law? And why isn't it the same for everyone? And it's not. And so we're going to get into the more specific differences between different entities through which you will report income and expenses here in the next few minutes. So next slide, please. Again, we're discussing taxable events and tax brackets. Again, tax brackets primarily deal with individual taxes, whether you're filing single, married, head of household, married filing jointly or separately. Those tax brackets have changed with the Tax Cuts and Jobs Act. But the taxable event, I do want to spend a little bit more time on. So next slide, please. These are the tax rate schedules. This slide is a couple of years old. You need to know that it's still the rates start at 10%, 10, 12%. They go up, but the categories and all that are still the same: single, married filing jointly, married filing separately, and head of household. And my task here is to convey to you that you being self-employed individuals, that you can really impact the amount of income that you are going to report through one of these four filing statuses. So next slide, please. I only show this now. The corporate rates with the Tax Cut and Jobs Act of 3 years ago, this was dropped down to 21%. So all of this goes away, but I bring it up and I still kept it in the PowerPoint. This corporate tax schedule had not changed in 30 years. It was the same thing. The individual returns change every year, at least once every year. The corporate return rate, the tax brackets all stayed the same. Now it's 21% for the first dollar to a trillionth dollar. So there's no step laddering with that. But the corporate rates went from basically 35% down to 21%. Huge beneficiaries of the Tax Cut and Jobs Act, and to a degree, the smaller business owners, the sole proprietors, the partnerships, LLC, S corps, and all that, they did get some benefits as well with the qualified business income exclusion of 20% of your taxable income is excluded from your tax returns. But the ones who really made it with the tax cuts was the C corps, the ones who probably needed the help the most. But they'll take it, thank you, nonetheless. Next slide. Okay, we're talking the income funnel. We're talking the difference between a personal income and business income. When clients come to me and ask me to do their personal taxes and all they have is W-2s, they don't own a home, then there really isn't anything I can do for them. That W-2 income is reported to the IRS and the Social Security Administration. The state also gets their copies of the W-2s, and they're waiting for you to file a tax return and determine if you owe more tax or if you're going to get a partial refund or whatever. But unless you own a home and have mortgage interest to deduct and real property tax, I really can't do much for you if all you're going to show is personal income in the income funnel. If you do have some charitable contributions, that can be good, but you've got standard deductions of over $12,000, and for a married filing jointly over $24,000. You got to have a lot of charitable contributions. You got to have a lot of medical deductions to exceed the standard deduction. So, and non-reimbursed employee business expenses like use of car or use of computers or cell phones or whatever, those things have gone away with the Tax Cut and Jobs Act. There are no unreimbursed individual business expenses. The state of Hawaii still allows them, so it is worthwhile to report them. But on the federal side, you can't claim them anymore. So you best just go to your employer and ask for some sort of a cash reimbursement for expenses that you incur in performing your duties as a W-2 wage earner. So, but once somebody has a small business, then all of a sudden it opens up a whole wealth of possibilities. Most of the small business owners run their businesses from their home. That's what I do, although I do have an office, a virtual office down at Restaurant Row, but I'm never there. I always work from home or from the various Starbucks on the island, which have been, kind of shut down as of late with the COVID crisis. But I operate from home. I can write off part of my mortgage interest. I can write off my cell phone, my internet, my cable. I have computers, I have cell phones, business furniture and equipment, file cabinets. All these things come into play. My automobile, my wife's automobile, my son and my daughter are all corporate officers. All of their vehicles are corporate assets, and I write off all the expenses related to keeping those vehicles running on the road, whether it be registration, gas and oil, tune-ups, registration, all those types of things, plus the costs of those vehicles, write them off, depreciate them, or take accelerated Section 179 or bonus depreciation on all those assets, thereby keeping my net income from my corporation as low as possible. These are also advantages that you have as a small business owner. Now, that if some of you tuning in haven't started a business yet, I'm not telling you to go in on Monday with a resignation letter. We all need the cash flow. If you're lucky enough to still have a job where you're working even from home, you need to make sure that you perform those duties diligently and keep that cash flow coming in. But now you have a second job. You have a job of being self-employed, maybe a hobby that you enjoy doing, something that you can operate from your home, keep your expenses low, and give it a chance to see if it can gain traction out in the real world, that you can sell the products or services that you're trying to market. So with business income, it opens up a wealth of possibilities of tax deductions. Personal income, W-2 earnings, not so much. Next slide, please. Okay, when we're talking about being self-employed, we're talking about entities. I waited until I was 61 years old that the stars aligned for me to jump off the dock and sink or swim. I mean, I had the paycheck addiction pretty bad. In most cases, like most people, my paycheck was spent before I even got it, and so for me to finally jump off the dock and sink or swim, I waited until I was 61 years old, and now I'll never look back. But we can minimize the downside risk. There's organizations out there like SCORE who are just a phone call away to help mentor you, to help you navigate the minefields and icebergs out there that can sink small business entrepreneurs. But once you've decided to go into business, the next major decision that you need to make is what entity through which you want to report, to do the annual report card of your income and your expenses, known as a tax return. So these entities, of which I've got here, we've got C Corps, okay? And C Corps are living, breathing entities in the eyes of the federal government and the state, and they do pay income taxes. That's kind of the black eye on C Corps, is the double taxation. The corporation pays taxes on net income, and then the dividend income is taxed when the shareholders receive dividend income. My goal is to make sure that there is no corporate income to be taxed, one way or the other. And in doing so, that can produce a tax liability on the individual side with larger salaries, bonuses, and things like that. But the goal here is not to have the double taxation on the C Corp side. The other entities are pass-through entities. And what we mean by that is that the entity isn't assessed taxes. S Corps do not pay income taxes. Partnerships don't pay income taxes. A sole proprietorship, Schedule C, actually doesn't pay the taxes on the Schedule C either. Okay, limited liability companies and partnerships, LLCs, I'll get into in a little bit in just a moment. But the other types of partnerships, I don't deal with them very much. I hate partnerships. And I tell people to avoid them like the plague. But pass-through entities, what does that mean? It means that these entities file tax returns, but they're solely for informational purposes. An S Corp files an informational return, an 1120S. Partnerships file an informational return, a 1065, okay? Partnerships are an awful form of business, and I tell people to avoid them like the plague. I understand that if you're thinking about jumping off the dock, misery loves company, and so you want to hold somebody's hand as you jump. You need to avoid the temptation. I have known so many perfectly good friendships that went completely south in a very short period of time, as they thought that friendship could survive a business entity. Avoid that. That doesn't mean that somebody can't jump off with you, but they should jump off and form their own company, so that you can both contract with each other on an as need be basis. But avoid jumping into bed and forming a partnership, which I can almost guarantee will end your partnership in a very short period of time. But these entities, once again, don't pay taxes at the entity level. The share of income that goes to the particular owner, partners, or members comes via a K1. A K1 is kind of like a W-2 for S corps and partnerships. Okay, and so the partnership, your tax bracket may be completely different from your partner. Your partner might be in the very highest tax brackets, but you're not in necessarily that high of a bracket. And an S corp might have multiple members or owners. You can have up to 100 members of an S corp. Each one of those members might be in a completely different tax bracket. So the S corps and partnerships do not file taxes at the entity level. They're solely for informational purposes, and the K1s then are added to other income on the 1040 personal returns, and then they're assessed one tax accordingly. So entities are all important. You need to have an entity that keeps pace with the evolutionary growth of your business. If you're losing money, then you can go ahead and file a Schedule C and attach it to your 1040 tax return. But if you start making money, then you need to seriously consider reporting your income as an S corp. And if you get into $5,000 to $10,000 in taxable income, then you should possibly look at filing as a C corp. But let's see the next slide, please. Once again, we got the problem. We got the income funnel. We need to address, getting income out of personal side and into business. We've got the objective there of no tax to no more than 10% tax. Choices of entities. We need to estimate our income. For those of you who don't have a set of books, and your idea of putting information together is to maybe put some of it in a shoebox and take it to your H&R Block guy on April 15th. I got to tell you that I don't believe in the masochism theory of business management and income taxation. So you are required by federal law to keep records in such a way that your annual performance can be recapped and reported to the federal authorities and the state, so which is a tax return. So by federal law, if for no other reason, you need to keep a set of books. So whether that be QuickBooks Online or the Windows variety or Quicken, if those of you who don't have anything, then if later on I'll have a slide, my gift to you, a 5-minute financial Excel spreadsheet. There's no excuse for you not to keep timely and accurate records. Otherwise, if you don't have numbers going into the end of the year, you're operating worse than blind. And it's kind of like going to the dentist where you haven't brushed your teeth in a year. It's if you're a masochist, knock yourself out, do that. But most of my clients like to strategize. They keep financial records throughout the year. We tax strategize the beginning of the last month of their business year. We forecast estimate what their net income will be, and then we put together a plan to make sure that the taxes aren't there at the end of the month, at the end of the year. To do those things legally by investing profits back into the business, into fixed assets, plant and equipment, or buying supplies or whatever that you may have to buy anyway, 30, 60, 90 days in advance. Buy them before the end of the year. Put them on a credit card so you don't have any payments due for 6 to 8 weeks. There's various ways of getting those items on your balance sheet and income statement before the end of the year, so as to once again maximize the deductions and minimize the taxability of your hard-earned labor. So estimating taxes, I'm going to be discussing pros and cons of the various entities and what the pros and cons are more specifically in terms of deductions, fringe benefits, and that double taxation called the self-employment tax. The best solutions for tax strategies are the C corps are best, but obviously, if you're just starting out, you gotta crawl before you run a marathon. So in a lot of cases, C corps aren't necessary. The next best would be an S corp, and but all of you need to be aware of an LLC, a limited liability company, and I'll be getting into that with the next slide. During the 3-hour tax workshop, invariably somebody raises their hand and said, at what sales level should I, become an S corp? At what sales level should I incorporate? And my answer, and I try to change it up every time it's asked, but I told them it has nothing. The entity has nothing to do with your sales. You know, if you make $1 million and have $1.5 million in expenses, I mean, the revenue doesn't make any difference. What makes difference is the amount of taxable income that you have. That's the important factor. And when small businesses starting out, they may not make any money for the first year or two. Okay, and they can go ahead and file accordingly for that. They start making a little bit of money, they break even. As little as $5,000 in a year's time, then they should make an S corp election. If they're making more than $5,000 a year, then a C corp might be in their future as well. But what you're seeing here is that we've got the first 7 years of a new entity, year 1 through year 7, and you'll see up above there the business entity type. Right out of the blocks, you need to be an LLC. You need to be a limited liability company. The limited liability companies are by definition, they're a disregarded entity. They do not exist for income tax purposes. They are a legal entity in all 50 states. And as the name implies, they limit your liability from being sued for things that you do or for things that you don't do. Okay, this liability veil, isn't as good as a C corp, which have been around for 200 or 300 years. LLCs are the new kid on the block. They've only been in existence for maybe 30 years now, but it's certainly better than being a sole proprietorship. So legally, you can be an LLC in the state of Hawaii and all the other 49 states, but it's not a taxing entity. So when you set one of these puppies up, you've got 75 days in which to tell the IRS how you want to be treated for tax purposes. If you miss the 75-day window, all is not lost. You can make that election when it comes time for you to file your tax return for the year in question. But if you're losing money from your LLC, then you can take the default position, which in an LLC, if it's a single member LLC, you would file as a sole proprietor. If you haven't made a choice or an election to be treated as anything else, you would file as a sole proprietor on a Schedule C. That loss doesn't trigger income tax, doesn't trigger self-employment tax. As a matter of fact, that loss can be help reduce other income if you have a spouse who has W-2 income. So your overall taxable income can go down by that loss, and you pay less tax accordingly. If you have a multi-member LLC, then the default is that you file as a partnership. And once again, I can't be more emphatic about partnerships are the world's worst business formation. When I first got into doing income taxes after I graduated from college in 1973, giving away my age here a little bit, I went to work for a local CPA. Ed Uloa was his name, in the little hometown of Winslow on Bainbridge Island, just west of Seattle. And Ed quoted me something that I had a friend of mine. He was in a partnership, a printing company in the next town over. He partnered up with a fellow friend of ours from high school. Within a year, they hated one another. And that's when Ed said, John, you got to be more careful in choosing a business partner than in choosing a mate. And in my classes, I repeat it. I say, you got to be more careful in choosing a business partner than in choosing a mate. And so part of the reason why I dislike partnerships so much, but if you've got a multi-member LLC, then if you don't make an election to be treated as an S corp, then you are a partnership. And the problem with sole proprietorships and the problem with partnerships, well, there's a lot of problems with them, but with partnerships and sole proprietorships, you can't pay yourself. Okay, you can hire employees and you can pay them, but you can't pay yourself. Meaning that you can't lower your business net income by running payroll through for yourself and paying self-employment taxes and all that, or the Social Security taxes on that income. All of your net income from a partnership, your share of partnership operations, and from Schedule C sole proprietor operations are all subject not only to income taxes, but also the dreaded double taxation called self-employment tax. Okay. That's an extra 15.3%. So example being that if you had $10,000 of taxable income from your business. Whatever your tax rate would be on that would be one thing, but you'd also pay an additional $1,530 on $10,000 worth of sole proprietorship income. If that same $10,000 was on an S corp return and it came onto your 1040 return via K1, you would save the $1,530 because the net income from an S corp isn't subject to self-employment tax. So just by knowing that you could go ahead and check the box, request being treated as a subchapter S corporation, and could save yourself that additional taxation, most people would die for that opportunity, especially for the year that we've just had, where a lot of people have just lost a lot of money. But so anyway, it has nothing to do with your sales. It has everything to do with your taxable income, and you're not going to know what your taxable income is unless you get your damn financial records together. You need to have your QuickBooks up to date. You need to reconcile your bank accounts and your credit cards. You need to have dedicated accounts for all those things. Do not commingle business income and personal income. So have a dedicated checkbook, a dedicated credit card through which all of the income flows and all the expenses flow out of it. Do not commingle. If it came to the light of day and the IRS knocked on your door, you wouldn't like the outcome. So you need a dedicated bank account, and if you do use credit cards, have a dedicated card as well. It makes doing your monthly financials all the easier. So next slide, please. I'll get in quickly into some of the advantages and disadvantages. Again, an LLC is termed a disregarded entity. It does not exist for tax purposes. If you don't make a choice of how you want to be treated for tax purposes, the defaults are if it's just you, a single member, you file as a sole proprietor. And if they're multi-members, basically you file as a partnership. Both of those are not very good options if you're making money. If you're losing money, then the impact is less disadvantaged. But anyway, the LLC does provide some liability protection, but there are exceptions, and I'm not going to get into them. But there is a veil of protection for liability's sake with an LLC, as the name implies, a limited liability company. Next slide, please. Another advantage of an LLC, it's really simple to set these up. If you've never heard of an LLC before now, then it's very easy to set it up. You just go to the hawaii.gov website, you click on the business tab, and there's a tab to register a business. And you basically select that you want to set up an LLC. You pay $76 for an expedited filing with the Department of Commerce and Consumer Affairs. They'll get back to you in 24 to 72 hours. Approving your name choice for your business, and now you're registered with the governor. Then you go on to the irs.gov website and you apply to set up an employer identification number, which is an EIN, and there's no charge for that. And you can print out the number, the letter with the number on it, right there from the comfort of your home. Both of those can be done in a half hour to 45 minutes. $76. Nothing for the EIN. Once you're registered with the feds in the state, all you need to do is get a dedicated excise tax license, and that's by filling out a BB1 form, and you can do that online as well for $20. So for $96, you can set up your little LLC, and you're legit with the feds and with the state. Okay, so you need to do that regardless of how much profit your business does in the first year. You need to use that as a starting point. The LLC is very flexible because, like I said, it's not a taxing entity, but it allows for the flexibility of you choosing an entity which best suits your purposes of minimizing the magnitude and the timing of paying taxes. I'm not going to get too much into the disadvantages of the limited liability. It's not that important. You need to know that LLCs do provide liability protection. Next slide. Okay, tax issues for LLCs. Should the LLC be taxed as a C Corp or an S Corp? Again, you've got 75 days after you form the thing to fill out Form 2553. If you miss the 75-day window, you have to go ahead. The only time you'll have to make the election later on is when you file the tax return for that year. You still use the Form 2553, but you have to rely on your tax preparer to utilize a revenue procedure, which basically throws your tax preparer on his sword, where he takes the blame for your ignorance. And but there is a revenue code that does allow for the late election for being treated as an S corp, as long as that return is filed on a timely basis. Okay. Again, the savings tax-wise for an S corp is that the net income from the S corp is not subject to the self-employment tax like it is on a sole proprietorship. So that's the main difference. Next slide, please. Now we're going to get to C corps. I've got, I don't know, 50 to 60 clients who are C corps. And I have an equal number of S corps as well. But there's a reason for the Fortune 500 companies all being C corps. They have the best deductions for employee fringe benefits, accrual-based accounting, fiscal years, these types of things. The lobbyists have done a good job of convincing our legislative officials in Washington that that they need to take care of the big boys, the C corps. But there are advantages and disadvantages of them, just like there are with the other entities. So let's go to the next slide. We're going to compare corporations with sole proprietors, general and limited liability partnerships, LLCs. I'm not going to get into associations and co-ops. They really don't apply much, and I'm not going to spend any time on them. Next slide. And the advantages and disadvantages, next slide. The advantages of an Inc. are the limited liability and asset protection. Like I said, the corporate veil is very difficult to pierce. Also, indefinite life of a C corp. A C corp is a living, breathing entity away from its owners. So a shareholder who owns all of the stock of a C corp could pass away, and as far as the feds and the state are concerned, that C corp still exists. The heart still beats. So it's indefinite life of a C corp, unlike, say, partnerships. If a partner retires or dies or whatever, the partnership dies as well. It has to be reorganized. But corporations also allow for the use of fiscal years. All of my C corps, actually 99% of them, are a June 30th fiscal year. I divide the calendar year up in half. And we also use accrual-based accounting. We accrue year-end salaries and wages, which may not be paid until the first of the new year. We also do things like we accrue annual bonuses, and also we accrue the GE tax, which is normally not paid until the 20th of the following month. There's other things that you can do with accrual-based accounting to minimize the recording of income and the maximizing or the accelerating of recording expenses. So it allows you to spread income over different tax years that may be impacted differently by various expenses. There's also no taxes on reinvested income. So once corporate income is taxed, that income will not be taxed again. The only time it will be is if it is taxed as dividends. But reinvested income is not taxed but once, which is enough. There's larger deductions for fringe benefits. These could be medical plans. These could be retirement accounts. There's 13 different types of retirement accounts. C corps have the two best types. One is the defined benefit retirement account, which allows an employee of a C corp to deduct up to $400,000 a year from corporate income and contribute it to a retirement account that has that employee's name on it. So you can wash a lot of profit through an Inc. Far more than you can through any of the other entities. And once again, corporate income is not subject to the FICA tax, self-employment tax. So once again, great timing of the magnitude and the timing of taxable income and expenses. And we'll go to the next slide. Additional benefits, I'll go through them quickly. There's section 1244 and 1202. These are sections of the revenue code. And in my corporate record book, I specifically declare that we're going to go ahead and issue stock in accordance to the 1244 guidelines, and that we're also going to go with the 1202. 1244 states that we all know that if you have capital losses, if you sell stock at a loss, you can only deduct $3,000 a year in losses. So So it can be limited. But the 1244 allows you, if you have a catastrophic loss, you can deduct up to $100,000 of that loss in year one. And you know, at $3,000 a year, it takes you over 33 years to get the tax benefits of a loss, a normal capital loss. So this Section 1244 is one real benefit of a corporation, although we don't venture into these things to have huge losses. I'm assuming that we're all looking at a comfortable standard of living and an early robust retirement. 1202 deals with corporate shareholders. If a corporate shareholder buys stock as of 2010 and holds on to that stock for 5 years, that you can go ahead and not be taxed on up to $10 million in capital gain. So this is to help contribute to the investment into small corporations where the investor is kind of forced to hold on to the investment for a longer period of time, but definitely very powerful as an exit strategy for solely whole owned C corps, where the owner could look at possibly having up to $10 million worth of the gain of the sale of their business be tax free. I'm not going to get into some of these other issues. Other than the hobby loss rule, the other entities have a hobby loss rule which states that 3 out of 5 years you got to be profitable. Otherwise, the IRS can deem your business to be a hobby, which means they can tax you on all your income and disallow any deductions. I've never known the IRS to implement the hobby loss rule. That doesn't mean that they can't. The hobby loss rule doesn't apply to inks. Earlier today, through SCORE, I had a similar workshop. I had a question regarding, if you own a vehicle, can you go ahead and sell that vehicle, to your corporation? Yes, it's oftentimes termed a sale and lease back. Yes, you can go ahead and sell that asset to the corporation on the installment method or wherever, and those payments can be used to pay your note to the bank. But I use extensively my home office deductions, mortgage interest, real property taxes, internet, cable, all those types of things. I take a percentage of those as an expense on my corporate tax return. In addition, you got the carryback of net operating losses. The Tax Cut and Jobs Act did away with net operating loss carryback, but they've reinstated it because of the COVID situation. People are going to have huge losses this year, and if they can't carry it back, there may be years ahead before they have any profits in which to wash a huge loss this year. So they're now allowing you to carry back net operating losses, refile your taxes, get those taxes back, which is money that will be much needed to fund your business going forward. And again, I discussed the accumulated retained earnings benefit. But the next slide. Disadvantages are more expensive to set up. If you go to an attorney to incorporate your business, it requires a corporate record book and a corporate seal. They can charge $5,000 or more to set up the corporation, and you have the probability of maybe double taxation. And there's other record keeping, the annual meetings of the board of directors and the shareholders and all that. But once they're set up, they're not too onerous to comply with. And certainly the benefits accrued for being a profitable company reporting their income and expenses as a C Corp. I think the benefits outweigh these inconvenient disadvantages. Next slide. Okay, for those of you who are in the shoebox accounting method, this is for you. This is my gift to you. I created this a 5-minute financial spreadsheet about 10 years ago. I even use it in my company, and I've got QuickBooks, but I still will go ahead and recap my banking activity through this spreadsheet. I set up a monthly tab for every month of operation, and you can see down at the bottom there, you can see there's tabs. There's a yearly recap. There's January through December down at the bottom, and there's an information tab. Okay, this worksheet, I'm just putting in some sample activity just to show in theory how it works. If you need to customize any of the items on this worksheet, you can see up above there's an income and deposit section. You can see underneath sales and rentals and exempt sales out there's a column number 1 through 5 for income. And you can also see on the expense side, there's column 6 through 26. All of those headings are customizable, okay? If these particular headings don't work for you, then you want to change them. Where you change them is you change them down at the info worksheet. So if you could please hit the info worksheet tab. And you can see here, you can go ahead and put in your company name there, XYZ, Aloha Inc., whatever you want to do. You can also adjust the headings for your income there, and you can even change the tax rate amounts. This will do your GE taxes as well. Just to show you how this works, up there under office expense, column 6, if we would just go ahead and type in ABC there, and just hit enter. And now let's go ahead to the yearly recap and scroll on over to column 6. You can see that now it says ABC, okay? All right, go to January now, where it used to say office expense. It now says ABC. Click February. February, the same thing. Column 6 has now been reclassed to ABC. You do not change these on the individual annual or monthly tabs. If you do that, it's only going to change it on that tab, and it will not be picked up on any of the other fields, January through December or the annual recap. Now let's go back to January. I want to just show you briefly how this is set up to work. And even though I go through this and I explain how it works, when clients will come back to me and ask me to review this at the end of the year before they pass it on to their tax preparer, I see that a good 50% of them still ball it up and screw it up. And the way this is set up, it's all pre-programmed. Let's say that the monthly sales up there, the $4,000, let's go ahead and change that to $3,000. So if you please put the mouse cursor over the 4,000 cell and change it to $3,000. Not there, right there. Change it to $3,000. Hit enter. Now look what happened under the sales column. It was 4,000, but now it's 3,000. Let's say that it wasn't sales. Let's say that this was a rental income. So let's change the account from a 1 to a 2. And voila, the income miraculously goes in under the rental column, okay? That's the way this is set up. You just put in dollar amounts, knock yourself out on the customer and info sections over there. You can put in invoices or check number. You can do whatever you want, okay, with that part of it. But in terms of populating the income and expenses on these monthly tabs, you put in a dollar amount and you code it. 1 through 5 for income, 6 through 26 for expenses. All of those revenue and expenses are customizable on the info worksheet tab, okay? So again, I went ahead with, I said some of the expenses were outer island, which is at a different excise tax rate. And so we put in a column 5 there. Let's just go ahead and say that we had some sales to the mainland, which are really exempt. And so that would be column 3. So go ahead and change the 5 to a 3. And you can see it goes to the exempt column, okay? There's no tax on that at all. Let's go down to the, look at the rent there at $750. And let's just say that the $750 was actually, let's just say that it was a utility bill. Say it was the power bill instead, so that we don't have to scroll over. So we look over at the utilities, and that's column 12. So let's go ahead and change the 18 to a 12. And all of a sudden, the electric bill goes over into the utilities column, okay? So pretty simple, huh? There's no reason for not keeping timely and accurate numbers. If you've got a shoebox full of bank statements, credit card statements, and receipts, you have 14 days before the year is over with for you to get your act together to find out if you made any money or not. If you go on the bank balance barometer of if you made money or not, you say, gee, honey, I didn't drain the bank account last month. Maybe we're making income, taxable income. I can assure you, you are already making taxable income because those draws, those checks that you write to yourself to pull money out of your operating account, draws are not expenses. They're an allocation of profit. So yeah, you can drain your bank account because everybody's got to live, but you may have drained out $100,000 out of your business account, and it didn't show any increases from January through December. But that $100,000 in draws is taxable income, and you need to know that before the year is over with, so that you know what the challenge is for you in setting up a proper entity to allow you to keep most, if not all, of what you worked so hard to create. So I even got down there. I have GE taxes. I have various headings for all that stuff. I want to handle a couple of negative items, and they're down at the bottom. What happens if you have to give a refund to somebody? You have something that was originally recorded as a sale, but now you had to give part of it back. How do you handle something like that? Well, I have a customer sale refund down there. You had to give you wrote a check for $75 to give it back to a customer. Okay. And so the way you handle that is a negative sale. So it goes in as a negative $75, and you code it the same way the original transaction was done. Okay, let's say that you had to give back a partial rental refund. So rental income is column 2. Go ahead and change the 1 to a 2. Voila, the refund goes into the rental column, and you're all of a sudden the $3,000 drops down to $2,925. Okay, so negative income goes in as a negative amount and is coded to the same account heading as the original income went into. Okay, same thing with expenses. We had $135 that we spent at Fisher, Hawaii there. Now, if we had to take some of it back to get a refund because it was the wrong stuff, so we got a refund of $50. So down below there, we put in a negative $50, still saying Fisher, Hawaii refund, and it goes to the same column 6, okay? And you can see, voila, it's over there. The $50 reduces the $135, and the expenses adjusted down to $85. So sales refunds going as negative amounts, purchase refunds going as negative amounts. They're coded the same way the original transaction was done. You can go ahead and have multiple bank accounts on this. You can have multiple credit cards as well. That's a complexity which I could assist you if you have questions on how to customize this to add multiple bank accounts and additional credit cards. And you could initiate that by shooting me off an email to my Yahoo email address. But this is your gift. And again, I use this even though I use QuickBooks for my my corporate business. But this is a wonderful tool for accumulating records in a very, very short period of time. And this is yours if you want it. You just need to ask. Next slide. Okay. I was asked to do a presentation several years ago to the monthly meeting of the Hawaii Food Manufacturers Association, and so I was contemplating what I was going to, what kind of a presentation I was going to give. I had a half hour to 45 minutes, and I knew I had a group of farmers and all that, the small business owners, and I wanted to be able to illustrate in a graphic form how the way they report income and the entity through which they report income dramatically dictates how much of their money they get to keep and how much they have to write a check off to Washington, D.C. or Washington Place. So I started out with a Joe taxpayer, and he's got W-2 income. He makes $70,000 a year. He's a mason. He's in the construction trade and works for a general contractor. In each one of the scenarios that I'm about to bring up, nothing changes, okay? He doesn't make any more money. He doesn't spend any more money. It's just the entity that he chooses to use to file a tax return changes. And as a result, the rules and regulations that he's able to take advantage of change as well. But right now, he's got 70 grand, works his ass off, gets a W-2, and that's what we've got here. We're showing federal, state, total income, and then the Social Security. Okay, so he's got $8,842 in federal tax, $4,694 in state tax, Social Security at 7.65 on 70 grand is $5,355, a grand total $18,000 $891, just under 27% for the privilege of working his ass off, laying bricks. So let's see how that income gets treated if he's all of a sudden self-employed and he operates as a sole proprietor. Okay, now he's got deductions. He's operating from home. He's got the items, like I said, probably at least a third of that $1,500 a month in rent that he pays, and probably a good amount of his automobile expenses there can be written off on a tax return. Every time he backs his truck up, he gets 57.5 cents a mile in mileage deduction. So with him being self-employed, I'm conservatively saying that he has $20,000 in expenses, leaving him with net income of $50,000. Okay. I could very easily, with most of my clients, we could come up with 30 or 40,000 in deductions, but I wanted to be conservative for the sake of this illustration. And we're going with 20,000 in expenses. So let's take a look at the next slide and see how the taxes fall out as a self-employed individual on a Schedule C. Look what happens to the federal tax. Drops down from 58 down to just over $3,000. State tax is down as well, down to 28.66. The Social Security FICA taxes went up. Yeah, because he's paying 15.3% on $50,000 worth of taxable income. So if you take $50,000 after the $20,000 expense allowance, then 15.3% of $50,000 is the $7,065. Okay, that's the only tax that goes up. But look at the total. Before, as a W-2 wage earner, not able to deduct anything, he was being taxed $19,000, and now he just gave himself a $6,000 pay increase. He's not doing anything differently. He's not working any harder. He's just working smarter. He's funneling his income through a business, which allows him to deduct stuff. And he's got overhead now, which is tax deductible, which he did not have as an employee. Okay, so let's now go ahead and take this to the next step. The next evolutionary step is that he needs to choose an entity. He needs to know that he needs to be an LLC. He needs to be a limited liability company, and he needs to take advantage of the flexibility of that disregarded entity to choose the appropriate tax filing entity that'll save him even more money. So I have two different assumptions here. One is the $20,000 in expenses, and I also have him paying himself $20,000 in salaries and wages. Okay, so one of the slides will be a $20,000 expense. The other will be a $40,000 deduction from S corp income, and you'll see the fallout on both of those. So if I can see the next slide, please. Okay, we see there that the first of scenario 3 is that there's compensation of $20,000 and there's expenses of $20,000. The income tax is not going to change, okay, because whether or not the income comes over on a K-1 as a larger amount than some of it comes on as a W-2, the federal and state income taxes are going to be the same. The benefits come from the elimination of the self-employment tax, okay? With $20,000 in salaries and wages, that's subject to the 7.65% Social Security tax, so that's where the $3,060 comes from. But you still look at that with an S corp, the income from Schedule C down to an S corp, it drops down to $9,600. And if the individual doesn't pay himself in that first year, which is not uncommon for startup businesses, the taxes would go as low as $6,500. So where do you want to be? You want to be a wage earner paying $19,000, or do you want to be self-employed where you can start realizing the advantages of the tax code and dropping your income down pretty dramatically, okay? And you could do a lot with 12, 13,000 extra disposable dollars every year. You could send the kids to private school, put them, take a trip, possibly over a lifetime, buy a bigger house, add on to your home, all these types of things, add to your standard of living, most definitely, versus paying all that money out in taxes, to whatever degree you feel warm and fuzzy about that. And I won't editorialize any farther on that. But we got one final slide. And I got to preface this slide. As I told you, the C Corps can avoid the hobby loss rule. So the goal here, my goal with my clients is to operate C Corps at break even. so we don't worry about the double taxation, because corporations pay 21% of their income in income taxes, and the state has a graduated sliding scale of, I think it's 4.7 up to 6.7. So you add those on, you're paying 25 to nearly 30% in corporate income tax. So my goal is to make sure there isn't any tax there. But that process of eliminating corporate income tax could create a tax situation on the individual's personal 1040 tax return. If we have to pay larger salaries, if we have to pay year-end bonuses, those types of things can raise the income tax that's being reported on their 1040 return, which could require additional tax strategies as well. But this is what can potentially be done with an Inc. Okay, we can operate them at break even for an indefinite period of time. So now that you know this, when I first put this together, it kind of pissed me off a little bit. I just said, what? Why is it that you need to know this stuff? You know, the average husband and wife, the average person, you know, Joe taxpayer, he doesn't know this stuff. But what he needs is he needs to have somebody who can enlighten him to one degree or another. But as I asked the fellows at Boots to Business who were leaving the military, and I asked them initially if they felt they had to pay taxes, and then later on they said no. You know, everybody answered no. You begin to realize a little bit of information applied at the right time can reap huge benefits. So with this, behind which door do you want to be? Scenario 1, 2, 3, or 4? Now that you know how much control that you have, you know, death and taxes are not inevitable. Death, yeah, taxes not so much. We pay those because of our ignorance. But hopefully you're not quite as ignorant right now as you were, you know, before we got started. You have an immense control over the money that you make and keeping more than what you give away, okay? And so it's not what you make, it's what you keep that counts. And you have these various tools at your disposal of self-employment income and being able to write off various expenses, home office deductions, meals, travel, all of these types of things, funding pensions for yourself and for your children. These things are readily available to you if you have the courage to give up, to one degree or another, the payroll addiction and jump off the dock. But again, I would say hang on to your day job, work from home, you have your second job, see if it gains traction out in the real world, that people want to buy the products and services that you're wanting to market. And once it takes off, which hopefully it will, you can tell, you know, you have choices now. You can tell your employer, thanks, but no thanks. I'm going to go ahead and dedicate all of my efforts to my own business. So this is a culmination of over 40 years of what I've done in accounting and in the small business community, is to illustrate and enlighten small business entrepreneurs to help support them in achieving their financial and retirement goals. Let's go to the, I think it's the final slide, Excel sheet. I wanted to mention too, this is my Yahoo email address. If a lot of you don't want to take the time for the chat room Q&A, question and answer, and I can understand that completely, that you may not want to ask a personal business question, you can shoot me off an email and I promise to get back to you in 24 to 48 hours. Also, if you would like to have the 5-minute financial and this sales and expense budget break-even spreadsheet, I'll send this to you as well, my gift to you. But a lot of you have never put together a business plan, and at least you could possibly utilize this spreadsheet to put together a budget for the coming year, listing your sales revenue along with cost of sales if it's apropos, and then you can go ahead and plug in various expenses. What you'll notice here is that there's a column over on the left there for fixed costs and variable costs, and that's where the ability to calculate a break-even, a monthly break-even, comes in by the amounts that you put in here under fixed cost, and the variable cost percentages affects what you'll see up above there. You'll see on row 3, it says the monthly break-even for this particular Aloha Incorporated is $51,826. Okay, all of these things are programmable. For instance, You can see the advertising, promotion, and donation column there, column 24. If you put the mouse on the $500 fixed amount, we'll go ahead and delete that, and you'll see what happens to the. So go on down to the row 24, column B, and then let's just go ahead and put in 0. That's fine, and see what happens. You see the expense goes away. Okay. Now take a look at the break even up above. It was up there up above, $51,000. It's now dropped down to just over 50,000 because we got rid of a fixed cost, one less dollar in cost that we need to generate gross margin, to cover that nut every month. But each one of these is programmable. You can have a fixed and a variable amount, which you can look down at the sales for the kitchen. This is a restaurant, or sales for other, supplies for other. You can see where I have fixed amounts and variable amounts. So as the business goes up in a restaurant, obviously you can just imagine that there are certain expenses that have a variable component as well. The way I give this, the sniff test, is over on the right-hand side. I have the actual income and expenses for the previous 2 years, and I can go ahead and compare my budget forecasts with the actual information and see how closely my budget assumptions mirror the actual historical amounts. So once again, in lieu of a business plan, there's nothing like having a budget break-even forecast that you can show the bank or whatever, and so this is yours for free as well. Okay, my time is almost up, and so what I wanted to do is that I've covered a lot. You get into Schedule C's, LLCs, S corps, C corps, the old alphabet soup. It gets very, very confusing. I've been doing this for a few years. It's not my first rodeo, so for me it's like rolling off a log. But I want to give you what I feel are the most important points, the takeaways for this session. And basically, you need records. You need to have QuickBooks. You need my 5-minute financial. If you don't know if you've made money this year or not, you're operating worse than blind. Okay. And I can't reiterate enough that you need to know between now and the end of the year if you made any money or not. Okay. Simple as that. You got to have good, timely, accurate numbers that you can pass on to your accountant and or your tax guy. You need to set up dedicated bank accounts and credit card statements. Do not commingle money. And also, don't forget that a lot of you, if you're just starting out in business, you're bringing personal assets to the dance. You got a truck, or you got a vehicle that you use. You don't take the bus to go to clients' appointments and stuff. You got your own vehicle. You're now consuming the usefulness of a personal asset in the generation of business revenue. Business revenue, which the IRS and the governor will love to tax the hell out of you for that income. So you have every right to use that resource that's being consumed. Cars only have so many good miles on them, and you're using part of it to generate revenue. You get to deduct the cost of that car. Okay, you can go with full Section 179 depreciation, take bonus depreciation on the whole thing as well. If Section 179 and bonus are foreign terms for you, and you've been in business for a while, you might double check prior tax returns to see if your tax preparer actually took depreciation on assets that you know that you bought. Okay, so you need to make a list of any of the personal assets. I would start with vehicles, office furniture, computers, cell phones. All these types of things are personal assets which are now being thrown into your business and being consumed to generate taxable income. You have every right to claim them and deduct them accordingly. Okay, and basically that's it. If you know how much money you've made, you know what the challenge is. You know what you need to do. You need to reinvest your available profits back into the business to fund and fuel the expansion of your business. If you know that $1 in your bank account at the beginning of the year can be $2 or $3 at the end of the year, you begin to realize how costly it is to write a check to the IRS or to the governor and pay taxes. That money's not there to fund the expansion of your business. And where's it going to come from? Well, you can use credit cards and pay the double-digit interest rates. You can borrow money and have interest as well, charged as well, or you can work a little smarter. You can look into your looking glass and say, what do I need to buy anyway in the next 2 or 3 months? I'm going to buy it now. Use a credit card to buy it, conserve your cash and pay it, in 4 to 6 weeks. Go down and buy a car. It's a good time to buy cars. Everybody's got a car ad on TV right now, and nothing like what a new car does to improve your spirits going into a new year. But if you buy a $25,000 or $30,000 automobile, if it's the right automobile, you can write the whole thing off against your income taxes, even though you bought it the last day of the year and you financed the whole thing. You don't have a single dollar in that asset on your tax return for that year. Obviously, you got to make the payments, the monthly payments going forward, but a bird in the hand is worth two in the bush. So my congratulations for you in being self-employed. My hat's off to you. Like I said, I was 61 years old before I decided to jump off the dock. For a lot of you, a lot younger than that, I'm in awe that you have the courage to do something that I did not have the courage to do until much later in life. I want you to know that you have individuals through SCORE Hawaii, which I'm a mentor, who are there just a phone call away to mentor you at no cost, to navigate around the icebergs and the minefields that are out there from January through December, to enable you to keep most, if not all, of what you worked so hard to make. So with that, I wish you well. Happy holidays and a most profitable new year. And we'll turn this over to the any question and answer. If some of the question and answer are a little too particular or too in depth, I'll encourage you to go ahead and shoot me off an email, and then we can arrange to get in touch on that going forward. But in the time allotted, if we do have brave individuals who would like to ask me a question, to the best of my ability, I'll try to answer. Thank you very much. Aloha.
John, thank you. We thank you so much for your time today. Great information. I'm sure a lot of the small businesses will be able to take some of this information and utilize that. So again, if you want to reach out to John, his email address is jbshawaii@yahoo.com. If you have any questions, please send them over now where John can address them. Or like you said, you can send them to him directly and he'll address it privately.
Yeah, this morning we had a question regarding the PPP, the Payroll Protection Plan. And I know that a lot of small businesses partook of that out of necessity, or it was as it was presented. They went ahead and applied for it, not knowing, if they were going to need to utilize it or not. But right now, the law of the land, hopefully Congress is going to pass something here in the next few days. And all indications are, I received a word from Mark Spain, who's the acting director of the SBA, and also with Steve Dealey, who's one of the most knowledgeable people on federal income taxes in the world. And they both alluded to the fact that the PPP money will, to a certain degree, either 50,000 or 150,000 will be automatically forgiven and will not be taxable income. Okay. But what people need to know right now, it's the law of the land that even though the PPP money is not taxable income, if you spend it in the forgiveness regulations as payroll, rents, and all that, it's a forgiven debt. Normally, debt is taxable income to the debtor, but the federal law in this case is that this forgiven debt is not taxable income. But the problem is that you can't deduct the expenses either. Okay, so if you have a $50,000 PPP loan, yeah, it's not adding $50,000 to your taxable income, and it's not subject to state excise tax. You can't deduct the $50,000 in payroll. Okay, so if you operated at break even, after deducting $50,000 in payroll expenses paid for by the PPP loan program, you now have $50,000 in taxable income, taxable at whatever your rates are. So most people aren't aware of that, but what's supposed to happen is that the legislation is supposed to make it so that you don't have to file for the forgiveness if you're anywhere between 50 and 150,000 in loan amount. And they're talking about making the PPP loan money tax deductible. So we're all just kind of in a holding pattern right now as it relates to what is Congress going to do with regard to this issue of a lot of businesses do not have this money to pay back to the feds and to the state. and it kind of defeats it and is in contrary to the whole notion of trying to assist businesses to keep their employees being paid instead of draining the state unemployment funds and all that. It seems to run completely contrary to that notion. But hopefully, we'll have good news in the next few days.
Thank you so much for that bit of information, and we are all hoping for some good news over the next few days. Is there any questions for John at this time?
And if you're bashful, I completely understand. That's why my email address comes in handy.
And again, John's email address is jbshawaii@yahoo.com.
Was there a question there?
No, sorry, yeah, you beat us to it. There was a question about the PPP, but it sounds like you've answered it. So that's all I see for now.
Okay. Yeah, like I said, normally when I conduct these down at the SBA, not Restaurant Row, 3-hour workshop on this topic, some of the braver attendees will ask questions, but the vast majority of people, much like public speaking, they don't want to draw the attention to themselves, which is understandable. So after the workshop's over with at noon, they might wait in line for an hour, hour and a half to ask me specific questions. So that's very, very common. I've gotten used to that the workshop really doesn't end when at noon, that the people line up after that to ask me particular questions. So to the extent that you have my email address, I can field particular questions. And we could even converse over the phone at a time convenient to all sides to go over more specific strategies with regard to tax planning for year end and entity setup going into the new year.
That's so true, John. And I might actually fall into one of those categories you just mentioned. But yes, we'll be able to reach out to you, definitely. And
now, Wendy, you were breaking up there. I didn't hear.
Sorry, if there is no more questions at this time, we can go ahead and end the session. You can either send it directly to John at jbshawaii@yahoo.com, or you can send it to us here at the city and county at backonthewave.com as well. We want to thank everyone for attending today. We want to thank our panelists, Dr. Hao Nguyen, as well as John Schuyler. We're sorry our other panelists could not make it today. However, we do appreciate everybody's time at this time. So thank you so much, and we wish happy holidays to everyone out there. And we'll see you back in 2021.
Happy holidays.
Happy holidays.
Thank you.